So let's begin with the big issue, a tug of war between solid economic data and risks to the outlook.
Things are a little bit better than people think.
As investors try to dig through this, they have to look at the underlying trends that were happening regardless of the trade issues.
Not resolved, but kind of put a little bit to the side.
Central banks will have the ability to manage some of the downside risks.
The framework that the core of the committee is operating with is a risk management framework.
People at this point see the Fed taking action.
We have very supportive policy. Trade dispute is always going to be this dark cloud.
Trade tensions are pretty much here to stay.
There's absolutely increased uncertainties.
I don't think that the trade tensions in and of themselves are going to have a material, real impact.
So the key question, can the Fed insulate the economy from trade-related disruptions? Joining me now around the table, Eric Liu of Vanda Securities, Tony Rodriguez of Nuveen and Dan Skelly of Morgan Stanley Wealth Management. Your thoughts on that, Dan? Can the Fed insulate us from some of the disruptions we see worldwide?
We don't think so, Jonathan. And in fact, we've been saying this for a while. The market has been so myopically focused on the Fed, with the lion's share of the S&P total return this year actually being derived on days where Jay Powell has spoken. We've talked about this. We think the Fed just becoming easy doesn't solve the earnings picture, and we'll talk more about that.
Just break down the numbers for us. How important have the days when Chair Powell has spoken through 2019?
So if you look at SPX up, call it 19-20% this year, that's about 340, 350 S&P points. Of those 350 points, about 190 have come on 3 days where Powell has spoken. So that's 60% of the total return.
Eric Liu, your thoughts?
I entirely agree with that. I think the biggest risk in the market right now probably is Fed expectations, given how extreme they are, particularly in the equity space as well as the fixed income space. But I think the rates markets are kind of baking in some downside a bit more than the equity space. But within equities, you know, if you talk about utilities, the heavy crowding and staples, markets in general, I think that's where the risk is.
Tony?
Well, I'd say that the bond market looked at in isolation in the U.S. would tell you that it's thinking recession. But when you look at it globally, it's really about the negative rates that are impacting global markets. So rates aren't quite necessarily reflecting a recession outlook. They're just reflecting kind of a flight to quality bid, risk in the marketplace because uncertainty is high, and the fact that it's still the highest yielding, most liquid, safest market in the world.
And at the moment, though, Tony, the data is okay. Inflation coming in a little bit firmer relative to expectations last week. Retail sales yesterday, even in Europe and Asia, things just starting to pick up just a little bit. What are your thoughts on that?
Well, I think that is supportive of risk assets. It's supportive, I think, of equity markets for sure, but also in the fixed income space. If you look at the credit markets, if you look at emerging markets, the consumer's in pretty good shape. Yes, there's a lot of uncertainty. Yes, certainly if you look at PMIs and the global manufacturing picture, that's slowing down. But overall, the picture is one of continued, I think, mediocre growth, not of impending recession.